Hi, I'm Ethan Pausner. Thank you for joining me on this webinar where I'm going to be discussing working on your business as opposed to working in your business. There are three goals I have during the next 45 minutes. The first is to discuss what I'm talking about, why it's important. The second is to provide a framework for discussing and analyzing your business on a go-forward basis. And the third thing is to leave you with some concrete steps you can take to start the process of learning how to work on your business. Why is this topic important? And the answer is because sooner or later you're going to be selling your business. The question is not whether you're going to be selling your business. The question is, when are you going to be selling your business and at what price? Many people, in fact most of the people I work with, have no concrete retirement date or goal in mind. And when discussing the topic of the financial performance of their agency, the main concern they have is the short term. Am I making money this year or am I not? We can't predict the future, so we don't know when we're going to want to retire or when a death or disability is going to cause us to have to retire. Each year there are agents who have to retire, or they have been disabled and can no longer run their agency. At that point in time, they now have to sell their agency. What is their agency worth? The answer is any title agency is primarily valued on three things: the total amount of profit it's generating each year, the profit margin that it has that creates the total dollar profit, and the third thing is the systems in place that ensure that the agency will run without the owner. Thus, because most title agencies are primarily staffed with owners who are a key part of the business, the ability of the business to run in the short term or even medium term without them as effectively is diminished. So an agency that has a key employee being the owner who's selling it means that if the owner is ill and can no longer work and has to sell the agency, it's worth less to a buyer. So let's talk more about what it is to be working in the business and compare that to the topic of working on the business. Let's take a look at this first slide. When you're working in your business, it means your focus is getting the daily work done. Most agencies I work with, the owner is one of the key examiners or key closers, or the third alternative is the daily business manager, and wears a number of hats, including substitute examiner or substitute closer when there's a problem. The focus is day to day, our orders coming in, our commitments going out, our closings taking place, and our policies being reported. Strategic issues, those will have to wait to another day when it's not so busy. Contrast that with working on your business. When you are working on your business, you have stepped back from the daily operations and you are focusing on making sure that the business of the business is running smoothly. Do you have a process in place for hiring people, or for training people, or for monitoring quality control, or for making sure the computers are all up to date and that any safety patches or technology patches have been made, and so on. Stepping back, looking at how the business is flowing, talking with customers outside of the context of the immediate closing and asking how they feel your business is doing. The idea being that you are putting or have systems in place that don't require your daily presence there. Here's a concrete example. Think of Debbie Fields, the woman who invented Mrs. Fields cookies. The folklore is that she started baking cookies. Friends and family said they were really good and that she should be selling these. She started selling these. Eventually, it started growing to the point where she couldn't manage the business and still be in the kitchen baking cookies. So she had to figure out how to hire people. She had to figure out how to get supplies. And you can think of all the other things that she had to figure out how to do, which she could not do if she were also baking cookies every day. So that's all I really wanted to say about working on your business versus working in your business. It's important to work on your business because one of the key values of your agency to someone else is the systems in place that ensure it will keep running without you. In addition, you cannot be maximizing the efficiency or profitability, meaning the profit margin or the total profit dollar, if you're not focused on the business of the business. Imagine trying to navigate through a forest going from tree to tree versus having an aerial map or an aerial photograph of the forest. Let's switch gears now and talk about a framework for discussing your agency. In this slide, I have what I call the agency analysis triangle. And the purpose of this agency analysis triangle is to provide you a tool for making decisions, but more importantly, for thinking about your business and the challenges and opportunities facing the business. Using this simple tool, there is a straightforward process for making decisions. Let's talk about the key elements of the tool. There's the management, the revenue, and the expenses. Let's start out with the easiest thing, revenue. Revenue is money coming in. You'll notice beneath revenue here that I've got sales and marketing. Sales and marketing are the events or activities that bring business in. Sales, generally defined as one-on-one activities between your company, or your agency, and a potential customer to convince them or entice them or lead them into using your agency. Marketing is not one-on-one activities or one-to-many activities. Sponsorships, for example. Webinars or educational events would be another example. But as importantly, word of mouth. Your agency's reputation that has spread through the community through word of mouth is marketing. It is legitimate to have great service that results in your customers spreading the word about how good your agency is. That's clearly marketing. Let's talk about expenses. Expenses, it represents money going out. Expenses are created by operations. Operations include things like opening the doors, paying the rent, utilities, and more importantly, the people and the things they're doing every day that you're paying them for, and as well as the supplies they're consuming. So revenue is money coming in, expenses is money going out. What's management? Management is two things. One is, generically speaking, it's the decisions, the body of decisions that are being made. The other thing is that it's the system by which decisions are made. And in that regard, I like to talk about management and metrics. Metrics are two things also. The actual measurements. How much money did we make? How many files per employee are being processed each day? Metrics is also a system, though, of managing those numbers and making decisions based on those numbers. So when I'm talking about management, I'm talking about making decisions based on numbers. And that provides the solid objective foundation for the ultimate management decisions to be made. For example, we all know and have worked for companies where there is an employee who's way past their prime and is just not being effective. If you look at the metrics, they would clearly state that this employee is not pulling their weight. And certainly, we would recommend looking at the metrics so that you can at least define the scope of the problem. Here's an employee doing a third of as many deals per day as everyone else. We are not saying that metrics is the exclusive way to make a decision. We are saying it's the foundation. You can make the decision to keep the employee out of loyalty. In fact, most people do that. That's fine. The purpose of what this larger working on your business discussion is about is having you be able to make decisions based on numbers, based on objective standards, but then feeling free to override those based on other issues. Let me kind of focus this a little bit without getting into concrete numbers and give you a situation to show you how this works in general. Let's say that there's a new regulation that comes down from Fannie Mae, which says that you need to have 2 separate new certifications executed by the borrower at a closing. Obviously, this means it's going to require more work by your staff, which means your expenses are going to go up. If your expenses are going to go up, that means your profit margin and your total profit at the end of the year are going to go down. You, as the owner or management team, have to decide what you want to do about that. Do you want to decide just to accept that and just make less money? Or do you want to try to counteract that? If you want to counteract that, you need to bring in more revenue to offset the increased expenses. How much new revenue can you bring in? And what method will you use to bring it in? Are you going to sell more? Are you going to figure out how to market more? Those are things that you can't really make good decisions about if you don't have measurements in place. So the agency analysis triangle allows you to take any opportunity or any challenge and break it into what's its effect on revenue, what's its effect on expenses, how much of each do we need to alter. Let me explore that a little more detail. When I say how much of each do we need to alter, I had just a few minutes ago said if your expenses are going to go up because of these 2 new forms, you can either choose to just accept, take your lumps and make less money, or you can consider getting more business. But if you can't easily or quickly get more business, for whatever reasons, you can look at your operations and say, well, where can we cut some expenses from our operations? Where can we look at workflow or other things we're spending money on and save money to counteract the increased costs of this new regulation? So that's, in a broad overview, what the agency analysis triangle is all about, and we'll come back to that later on. Let me rewind a little bit. Working on your business versus working in your business means working on how your business operates, how it makes decisions, how it spends money, how it brings money in, how it improves, what actually the goals of the business are, what's its market differentiation. Is it better service? Is it better pricing? Is it better everything? Better title quality? Those are things that you need to be focused on and thinking about to maximize the value of your agency so that when the time comes for you to sell, either voluntarily or involuntarily because of a death or disability, they're in place and your business is worth as much as it could be. One of the types of calls we get are from people who say, I've had enough, I want to retire. And we have to break the news to them that if you want to retire, you really need to be planning 3 to 5 years ahead of time, because you need to have a track record of financial performance, systems in place, and profitability. And you can't generate that overnight. one of the problems we have is lawyers who have law firms in the same building as their title agency, and their books are commingled. I'm not talking about the trust accounts. I'm not talking about the escrow accounts. I'm talking about everything else. Payroll, IT, rent. It's all commingled because it's the same owner. Well, the problem is if you want to sell the title agency, you have to unravel all that. Okay, but enough of that. That's probably going into too much detail at this point. Let's move to the next topic, which is what else do people use besides this broad framework of the agency analysis triangle? What do they use to work on their business? And the first thing they work with is a profit and loss statement, a P&L. Now, a P&L is generally generated by QuickBooks, and in fact, let me show you a picture right now of a P&L. This will help the discussion. This is a standard QuickBooks P&L. It's a financial compass with only two directions, north or south, or making money or losing money. Let me zoom in on it a little bit. You'll see the revenues are here. I'll highlight them so you have to guess. Revenues are here, 97,361, and the expenses are all listed down here, and they add up to 77,225.86. So a profit of 20,135.39. And then the same. This is the year to date, profit of 19,406. Revenues of 194,662 up here. So what? Well, what does this tell you? That the agency is making money so far year to date. $20,000 this month, $19,000 year to date, which means they must have lost money last month. Most of our agents use the P&L just like this. Unfortunately, this P&L doesn't help run a business. It's a rearview mirror telling you how you did last month. It doesn't help you figure out what you need to make more money going forward. It doesn't help you analyze where you may have systems that need improvement or where you're missing systems entirely. You can't tell that from this form of P&L. In order to even improve on this a little bit, you need to reorganize your P&L to look something more like this. Here's a P&L which breaks things down into categories. And when I say breaks things down, I'm talking about expenses. Revenue is generally limited to 1 to 3 areas in a title agency. Closing fees, title insurance premiums, and often search fees that are for uninsured services. We're not really focused, and I don't really focus on the revenue other than just to have it tracked accurately. It's the expenses that matter. So let's zoom in here. Here are personnel expenses, facilities expenses, supplies and postage, other operating expenses, T&E, which is generally not huge for most agencies, advertising and marketing, which is often very limited too. Why is it important to have personnel expenses in a category where they can be measured and benchmarked? What do I mean by benchmarked? There are general levels of, or general benchmarks by which you can measure your agency's personnel expenses. If you have 100% personnel expense, obviously that means all the money you're bringing in is being spent on personnel. That's obviously absurd. But a lot of people have personnel expenses that are 50% to 70% of their revenue, and that is where money is being lost. We believe, based on working with customers as well as working with our direct operations, that a title agency's personnel expense should be somewhere between 42 and 50%. So let me go back to this P&L here. This is the standard QuickBooks P&L. Let me erase these for a minute. See, these aren't going to be helpful right now. And I'll ask you if, and I'll even zoom in a little bit, how do you know what the personnel expense is using a standard QuickBooks profit and loss statement? I don't know. The answer is hard. Here's payroll taxes, that's a personnel expense. Here's health insurance, that's a personnel expense. Here's life and disability. That's a personnel expense. What else? Wages, certainly a personnel expense. You get the point. In order for you to figure out whether you are spending too much on personnel, you have to go through this P&L and do a lot of math by hand. It's hard to have a systematic approach if you're doing things by hand. So the P&L is an important tool that every agent needs to have, but not just for the rear view mirror purposes of determining whether you made money or not. Your bank account can tell you that. It's because in order for you to properly monitor your systems, one of the things you've got to look at is your ratios, your labor ratio, meaning your percentage of personnel expense to the amount of money you're bringing in, as well as the other expense items too. So that's one piece of the puzzle, is to work, in order to work on your business, you have to recategorize your QuickBooks P&L. It doesn't mean you have to fire your bookkeeper. It doesn't mean they've got to redo your books entirely. But it does mean that somebody's got to figure out how to come up with a different spreadsheet that groups the expenses together. Since this webinar is not an advertisement for the services that we at Fidelity provide, I won't go into detail other than to say we do this. In fact, I specialize in this, working with agents from small to medium size to large size, helping them use their P&L more as a steering wheel and less as a rearview mirror. Well, what else is important then besides a P&L? Let's talk about a budget. Most people I've talked to hate budgets. They hate budgeting. I'm not sure why, but I think it's partly because they feel that they have to commit to something in writing, and if they don't make it, they're to be shamed or disappointed or frowned upon. Really, that's not the purpose of the budget. The budget is a roadmap of how you are planning on making money next year. That is, how you are planning on bringing revenue in and how you are planning on spending the revenue. It doesn't mean that crazy things can't come up and make your budget irrelevant. But what it does provide is an early warning system when you're getting off track. For example, a simple analogy, if you're going to drive from Michigan to California, you don't need a map. You can just start driving and eventually you'll get to California. The question is, how much money did you want to spend on gas and how much time did you want to take just wandering as best you can, going east to west? Same thing with a budget. With a budget, it's a map that you've created. This is the route, the metaphorical route we're going to take. And if your revenue doesn't meet your budget, you can see that early on and actually figure out where the problems are coming from. Are there big customers who are no longer using you? And if so, why? Or is the general market down and your bigger customers are still using you as much as they always have, but relatively speaking, meaning relative to the amount of business they've got? They're still giving you 40% of the business, but their business is down 20%. Those are the types of things you can't determine without a budget, because you don't even know what you should be looking for unless you have a budget. Same thing on the expense side. I'm thinking of an agent in particular in Michigan. He's been out of business for a decade at least. But I remember this agent was struggling, to make payments to us and get stuff recorded. The basic stuff that you'd think an agency would be on top of. And I went to visit the agent, let's say 3 months later, after the meeting, where kind of remind him, you've got to be paying us, you got to get your stuff recorded and all that. Well, 3 months later I go to visit and they're in a new office building. And it's, of course, beautifully decorated and all that. So the question came up is, well, how could you afford to move into a new office when you've been struggling to, keep your recordings up and your systems operating and paying us? And the answer was something like, well, the builder here is a friend of my dad's, and he gave me a special deal on the first 6 months' rent. Okay, that's the kind of decision that's made without reference to a budget. There are other problems with that decision, but that's beyond the scope of this webinar. So with a budget, the budget is, in my opinion, easy to make. It's easy to construct a budget. First you break it into the expense side and the revenue side. And I'm going to keep this simple. With the expense side, what you do is you take your last full year's actual expenses and you look at them item by item and you decide whether you believe there's going to be any material change in those expenses. And realistically, electric rates don't go up that much. Rent can go up depending on your lease. But it's pretty simple to go through and quickly decide whether these are going to go up or not, and then using simple spreadsheet functions, come up with a new expense budget. The real challenge is on the revenue side, and the purpose of building a revenue budget is so that you have in your mind some expectations of where your money's, which customers that is, are going to be sending you how much business. And now with that, again, written down on a spreadsheet, you have some idea of how to determine whether a customer is all of a sudden sending you less business. You can determine it month by month as opposed to waiting for 3 or 4 months and thinking one day, I really haven't seen much of Wendy, the broker, in the last 3 months. I wonder what's going on. So again, the purpose of the budget is to create a roadmap of how you want to, or how you expect to make money, meaning from which customers you expect business, and a roadmap of how you're going to spend money. Then when used in conjunction with your monthly profit and loss statement, you can start to see how you're deviating from your planned course. That doesn't mean you can't change it. Now, let me rewind a minute and explain how that works. Let me go back to the agency analysis triangle. If I have a budget and I have a P&L, and every month I'm checking my P&L and seeing how it relates to the budget, and if I see that I'm bringing in less revenue than I had planned on, at least I'd mapped out in the budget, I can now determine what I need to do, or I can now approach how to make a decision about what I need to do. For example, let's say that the revenue is down 10%. Maybe your economy, maybe a plant closed, whatever. Revenue's down 10%. If I want to make as much total profit as before, but my revenue's gone down, then I probably need to reduce my expenses. How much? Good question. Maybe I don't want to reduce my expenses because I only have 3 employees and I really can't cut an employee. How am I going to reduce expenses enough to offset this 10% revenue decline? Well, maybe I don't want to and I can't cut employees. I want to do something. Well, maybe it's time to look at a sales and marketing, primarily a short-term sales approach. How can I go out and get more business, more new customers? How do I do that? Or, as I kind of mentioned earlier before, you can say, you know what, I think I'm going to make a management decision. Based on my metrics, I understand revenue's down 10%. I'm predicting that my profit will be down 15%. Short term, I'm willing to live with it as a management decision. That's what you can do. The triangle allows you to make a framework for making decisions, which is if revenue's down, if I want to preserve profit, I've got to reduce expenses, or go out and get more revenue to make up for where the revenue's decreased. And if I'm going to do that, I've got to figure out what I'm going to be doing to sell to get more customers. Okay, let's move then back to the budget and the P&L. So with the budget and the P&L, you are comparing each month to what your goals were in your budget. Are we on track or are we not? If not, what can we do about it? There's another thing about the profit and loss statement. As you get more and more refined in this process, you're going to want to compare the profit and loss or the monthly P&L results, not just to the budget, but you're going to want to compare them to the prior month. And when you get even more in with the program of working on your business, you're going to want to compare them to last year. Here's a simple example. An agent I'm working with discovered that their mileage reimbursements for their abstractors was not decreasing month over month in a year where the top 3 counties that they were searching or abstracting had all gone online. That led the bookkeeper to wonder what was going on. And the innocent thing was, well, maybe they don't know how to use the online access and they're not comfortable with it, so they're driving out there anyway. And the less generous thought was, well, maybe they're relying on this monthly mileage reimbursement because they bought a car that was a little more expensive than they thought, and they've been using that money to help subsidize it. But the point is that by having a budget goal for all your expense items and for watching the trend of that expense item, not just this month, but this month versus last year versus budget, the bookkeeper was able to see there was a problem and then work out what the problem was and what the solution was. So that's enough about profit and loss and budget. Let's talk a little bit about other metrics: productivity, open files per employee, and closed files per employee. When you have a concrete track record of how many open files per employee and how many closed files per employee are properly or within range of what they should be able to accomplish given your specific situation, you can now more effectively analyze what's going on. A common example is, I mentioned earlier, one of our agency managers will get a phone call which says, our people are swamped, we need more employees. Can you help me find somebody? Now what I would say to that is, well, how many open files per employee are they performing? Are they processing? And there is a wide range, depending on, of course, a lot of things: complexity of title searches, size of the parcels, commercial versus residential, refi versus resale. The overall idea is that there is a range of productivity. We like to say that if you are processing 15 open files per employee per month, which means if you have 4 employees, you're getting about 60 new orders a month. And if you're closing about 12 files per employee, so closing 48 deals per month, 15 and 12, if you're doing 15 and 12, you are certainly within range. Now that being said, we have agents who are doing double and triple that, but there's always more technology involved, including title plans. But we do have agents where they have, 9 open orders a month and maybe 8, 7 closed. And they only have 3 employees. And they would, if they have 3 employees, you'd expect 45. And you'd expect 3 times 12, 36. So in that case, going back to this triangle, if you are only bringing in 9 orders a month and you should be bringing 45 and you only have 3 employees, you can't cut expenses enough without closing because you have to have some customer service. Then the question, that the management decision is, how do we bring more revenue in? Not how do we cut expenses. You can't run an office with 2 people very effectively. I've been there, it's pretty hard to do. How do we bring in more revenue? Well, that's the management decision. The other management decision includes, how long am I willing to lose money to bring in more business so that I can start making money? I had an agent in a Midwestern state who spent the last 2 years of her agency's operation spending her retirement funds to support the people working in the agency. And she burned through it, and that was it. Never was bringing in enough business. Couldn't cut the staff, obviously wouldn't take any advice, had no real business sense. It was a tragedy. But the point is that even with this analysis and explaining it to her, she just couldn't pull the trigger and make the hard business decisions about how to make more money, how to bring more revenue in. So the metrics are important to trace, because when employees tell you in the middle of the summer that they're overwhelmed, then you have a benchmark, a minimum of 15 open and 12 closed, that you can compare. How are they doing compared to that? But more importantly, how are they doing compared to earlier in the year? And if it turns out that they are really swamped, and then the question is, well, do you really need to hire more employees, or do you need to look at the workflow and have them reduce the number of things they're doing? So let me start to wind this down. What we covered was why it's important to work on your business as opposed to in your business. The reason it's important is that at the point when you either voluntarily sell or your estate is forced to sell, the value of the agency is going to be maximized by having a higher total dollar profit each year, a higher profit margin, and documented systems in place that work, that allow the agency to run without you. In order to get to that point, and in order to learn how to work on your business, which is what's critical to get to that point, you need some basic tools, which include the agency analysis triangle, which is a guaranteed, or let me rephrase that. I acknowledge it's a simplified way of looking at things, but it really works. You need a minimum of a profit and loss statement that's organized properly, that is grouped, where expenses are grouped by what function they serve, not what their tax accounting is. And you need a budget to give you a roadmap of how you're going to make money and how you are going to spend money. And you also need some basic metrics goals. How many open orders a month is it reasonable to expect that we can do based on our past experience? And how many closed files per month can we do per employee based on our past experience? With those tools, you can start letting the numbers indicate where you need to focus, whether you need to focus on operations or whether you need to focus on revenue, or what the combination of both is. And that's where the subtlety comes in, which we're not going to cover, is how do you decide how much if you have a problem, let me rephrase it this way. If you have a problem, how much of it can be solved by more revenue and how much can be solved by reducing expenses? So let me leave you with some concrete things you can do. Number one, take your P&L and group the expenses that relate to employee costs, and that includes, for example, employee lunches, health insurance, unemployment comp insurance, education, continuing education for them, and wages, overtime, 401k, and so on. Group all those expenses in a category, even if you have to do it by hand, by a separate spreadsheet. You also want to categorize all your facilities expenses into a category. You want to have a separate category for office supplies and shipping. You want to have a separate category for title plant, or if you're buying title searches, whatever. I know this is not an advertisement for what we do, but this is the type of service that we provide and can provide for agents who are interested in exploring the concept of working on their business as opposed to in their business. Also, to start a budget, take last year's expenses, review them, and make a determination about whether they're going to go up or down and how much, either a percent amount or a dollar amount. On the revenue side, you need to analyze your customers. That is, break out all your orders from the prior year by customer, and if you can, by type, but generally by customer is good enough. And I'm saying not just by brokerage, but by, if it's a mortgage broker, the loan officer. If it's a real estate brokerage, which realtor. Break it out like that. Try to figure out how many deals you got from each party, and then either discuss with them how they think this year, 2021, or moving forward is going to be, and then from that, using basic averages, they brought in 25 deals, each deal was worth $1,000, so 25 grand. Using, that simple type of math, figured how much revenue you expect them to bring in this year. From that, every month, so now let me back up, rewind. You've got your expenses categorized. You have got a budget set up. Again, the expense side's easy, the revenue side's harder, but you've at least broken last year's revenue into who gave you orders and what their average deal size was and how many deals they gave you. So you got all that mapped out. Then the next step is to just do an order count for the last, again, using SoftPro or RamQuest or whatever. Figure out how many orders you had, maybe last year and the year before. Track your staff size and see if you can come up with an average number of orders per month for the year. Open orders and separately closed orders. And then with all that information, you can start to do a monthly analysis of how you're doing. Again, we're happy to help with that. Please contact your local Fidelity National Financial Agency account manager.